Welcome back to Money Mastery Now, the channel that helps you take control of your money, one smart habit at a time. If you want to master your budget, crush debt, and build lasting wealth, you're in the right place. Let's dive in. Are rising rents or home prices eating up your budget? If you feel like housing costs are out of control, you are definitely not alone. Across the U.S., people are struggling to find affordable places to live. Whether you are trying to rent or buy, it often feels like your paycheck just cannot keep up. Rent is more expensive than ever, and in many cities, home prices have skyrocketed to the point where even a modest starter home feels out of reach. For some, renting seems like throwing money away. For others, buying feels impossible without a huge down payment, perfect credit, and years of savings. So what are you supposed to do? In this video, we are going to break down smart, practical strategies to help you save money, whether you are renting your next apartment or preparing to buy a home. We will look at the real trade-offs between renting and owning. We will explore hidden costs you might be missing, and we will share small, powerful habits that can help you build toward financial stability, even in a tough housing market. So take a deep breath. You are not stuck, and you are not alone. Let's get into it. Let's talk about one of the biggest questions in personal finance. Should you rent or should you buy? There is no one-size-fits-all answer. But understanding the pros and cons of each option can help you make a smarter decision for your life and your budget. Let's start with renting. Renting gives you flexibility. You can move more easily, relocate for work, or adjust your living situation with fewer strings attached. Monthly rent is often lower than a mortgage in the short term. And when you rent, you usually do not have to worry about maintenance costs, property taxes, or unexpected repairs. That said, renting does not build long-term wealth. You are paying to live in a space, but that money is not going toward ownership, and rent can go up each year, depending on your lease and your landlord. Now, let's look at buying. Owning a home helps you build equity over time. As you pay off your mortgage, you are investing in something that belongs to you. A home can also bring stability, especially if you plan to stay in one place for a while. But buying a home comes with higher upfront costs. You need a down payment, closing costs, and enough savings to cover emergencies. You are also responsible for repairs, property taxes, insurance, and everything in between. So, which one is right for you? Ask yourself a few important questions. How long do you plan to stay? If you are planning to stay in the same area for 5 years or more, buying might make more sense. But if you're unsure or plan to move frequently, renting gives you more freedom. Do you have emergency savings beyond a down payment? Buying a home can drain your cash. Make sure you still have a cushion in case something breaks or your income changes. Are you ready for maintenance costs? As a renter, you call your landlord when something goes wrong. As a homeowner, it's on you. From leaky faucets to roof repairs, those expenses can add up quickly. In the end, the right choice depends on your financial situation, your lifestyle, and your long-term goals. In the next section, we'll dive into specific ways renters can save money without sacrificing comfort or safety. If you are currently renting, there are smart ways to reduce your monthly housing costs without sacrificing comfort or safety. Let's walk through a few practical strategies to help you save money as a renter. First, consider sharing your space. This is often called house hacking. If you have an extra bedroom, you might rent it out to a roommate or even list it short-term. If your lease allows it, that income can help offset part or sometimes all of your monthly rent. Even if you are just renting a room in someone else's home, it can be far cheaper than leasing an entire unit on your own. It may not be forever, but it could be the difference between staying on budget or falling behind. Next, take advantage of seasonal trends. In most cities, rent prices tend to drop during the off-season. This usually means the colder months from October through February. Landlords are more willing to negotiate when demand is lower. That gives you a chance to ask for a lower monthly rate or request better terms. If your lease is ending in the summer, ask if you can renew short-term and move during the winter instead. You should also ask about longer leases. Some landlords offer discounts if you commit to an 18-month or even a 2-year lease. Why? Because it gives them stability, and that stability could mean savings for you. Be sure to weigh this carefully. If you plan to stay put, locking in a lower rent can be a smart move. But if your job or life situation might change, flexibility could be more valuable. Now, let's talk about utilities. Sometimes an apartment with a lower rent might seem like a great deal until you factor in all the extras: electricity, water, trash, internet. If none of these are included, your real monthly cost could end up being just as high or even higher than a more expensive place that includes them. Always ask what utilities are covered in the rent. Get an estimate of monthly utility costs before signing the lease. So the cheapest option on paper is not always the cheapest in real life. Finally, consider location flexibility. If you work remotely or have a flexible commute, you may not need to live right in the city center. Suburban or outer neighborhood locations often offer lower rent, more space, and quieter surroundings. You might be able to save hundreds of dollars each month simply by moving 10 or 15 miles farther out. Combine that with occasional public transportation or carpooling, and you can keep housing costs down while maintaining a good quality of life. The key takeaway is this: renting doesn't have to mean overpaying. With a few smart choices, good timing, and a little flexibility, you can stay in control of your budget while living in a space that works for you. In the next section, we will shift gears and look at saving strategies for home buyers, especially those looking to buy for the first time. If you are planning to buy a home, especially for the first time, there are smart ways to save money and avoid common financial traps. Let's start with programs designed to help first-time buyers. Look into FHA loans. These are backed by the government and allow you to buy a home with a smaller down payment and lower credit score than most conventional loans require. Also, check for state-level grants and assistance programs. Many states offer help with down payments or closing costs. These programs are often available through local housing authorities and can save you thousands of dollars. Next, do not settle for the first loan offer you receive. Compare multiple lenders. Even a small difference in interest rate can mean big savings over the life of your mortgage. Also, make sure you understand the difference between a fixed-rate loan and an adjustable-rate loan. A fixed-rate loan keeps your interest rate and monthly payment the same for the life of the loan. An adjustable-rate loan may start lower, but it can rise over time, sometimes by a lot. That might work for short-term buyers, but it adds risk. Another tip: consider homes that need minor cosmetic repairs. These are sometimes called cosmetic fixers. The structure and systems of the house are solid, but it may need new paint, flooring, or fixtures. These homes are often priced lower than move-in ready listings, and sellers may be more open to negotiation. If you are willing to put in a little work, you could save significantly. Also, do not stretch to your financial limit just to buy a home. Avoid buying at your maximum budget. A good rule of thumb is to keep your total housing costs, mortgage, taxes, insurance, and any HOA fees below 28% of your gross monthly income. This gives you room to breathe, save, and handle life's other expenses. And finally, think beyond the mortgage. Homeownership comes with long-term costs that are easy to overlook. You will need to budget for property taxes, homeowners insurance, HOA fees if applicable, and ongoing maintenance. That includes small repairs, seasonal upkeep, and bigger costs like replacing appliances or fixing the roof. Plan for these from the beginning. Set aside a monthly amount for home maintenance, even if it is just a few $100s. That way, you will not be caught off guard when something eventually breaks. Buying a home is a big decision, but with the right preparation, it does not have to become a financial burden. In the next section, we will explore some of the hidden costs that often catch renters and buyers by surprise and how you can avoid them. When it comes to housing, the listed price is rarely the full story. Whether you are renting or buying, there are hidden costs that can quietly drain your budget if you are not prepared. Let's start with moving costs and upfront expenses. These include hiring a moving company, buying boxes and packing supplies, or renting a truck. If you are moving across the country, transportation and temporary storage can add even more. For renters, you will likely pay a security deposit plus the first month's rent, and sometimes even the last month's rent in advance. That adds up quickly, especially in high-demand cities. If you are buying a home, the initial costs are even higher. You will face closing costs, which can range from 2 to 5% of the purchase price. Then there are inspection fees, appraisal fees, and moving-in expenses like setting up utilities and purchasing basic furnishings. Next, let's talk about unexpected repairs. Even in newer homes or recently renovated rentals, things break. Plumbing problems, a failing HVAC system, or a leaky roof can appear without warning. These are rarely cheap to fix, and if you are not financially ready, they can throw off your entire monthly budget. In addition, furnishing a space can cost more than you think. Appliances, window coverings, furniture, and even tools like a lawnmower or vacuum all add to the total cost of settling in. Renters face their own hidden fees too. If you have a pet, you might pay a pet deposit or a monthly pet fee. Some properties charge application fees, administrative fees, or require renter's insurance. You might also be surprised by lease renewal fees or management fees if they are buried in the fine print. The key here is to plan ahead. Build a buffer into your housing budget for unexpected expenses. Even just setting aside $50 to $100 a month can give you breathing room when something goes wrong. When you understand these hidden costs before you move, you are more likely to stay in control rather than scrambling to cover last-minute surprises. In the next section, we will talk about how to build a housing fund that actually works and how to use it strategically whether you are renting or buying. Let's talk about building a housing fund. Whether you are planning to rent or buy, having a dedicated savings fund can reduce stress and give you more control when it's time to move. The first step is simple. Open a separate savings account just for housing. This keeps your housing money away from everyday spending. It gives your savings a clear purpose, which makes it easier to stay disciplined. Most banks and credit unions let you name your accounts. Try something like Future Home or Move-In Fund. That small label can help you stay focused on your goal. Next, automate your savings. Set up a recurring transfer from your checking account to your housing fund each month. Even if it's just $50 or $100, consistency builds momentum. You won't have to think about it. And over time, that habit will grow your savings without adding extra work or decision fatigue. Now, let's talk about setting specific targets. Saving without a goal is like running without a destination. You'll get tired fast. Instead, give your housing fund a clear number and a clear timeline. For example, if you are planning to move in 6 months, and you expect your moving costs to total $2,500, aim to save around $400 per month. If you're saving for a down payment on a home, set a realistic goal based on your local market and your loan type. Maybe that's $10,000 for a starter home. Break that down by month or by paycheck so you know exactly what to aim for. When your goal is visible and measurable, you're more likely to stay committed. You'll also be able to celebrate real milestones along the way, which helps keep motivation high. A housing fund is not just about saving money. It's about giving yourself options. It's about reducing panic when life changes. And it's about being ready financially and emotionally when the right place comes along. In the next section, we'll cover a few common mental traps that can derail your progress and how to avoid them. Even with the best intentions, it is easy to fall into mental traps when it comes to housing decisions. These beliefs sound logical. They feel familiar. But if you are not careful, they can lead to choices that hurt your finances more than help. Let's go through a few common ones and why you should avoid them. The first trap is the idea that buying is always better than renting. You have probably heard this before, but it is not always true. Yes, Buying a home helps you build equity. Yes, it can be a great long-term investment. But if you are planning to move within a few years, or your income is unstable, renting might be the smarter choice. Buying comes with closing costs, maintenance, property taxes, and more. If you sell too soon, you might lose money instead of gaining it. Renting gives you flexibility, and sometimes flexibility is more valuable than ownership. The second trap is thinking I need to buy now before prices go up again. This fear-based thinking can push people into buying too quickly or borrowing more than they can afford. Yes, prices can rise, but rushing into a major purchase out of fear is rarely a smart move. Stretching your budget just to get into the market can leave you house poor. That means all your income goes to your home, and you have nothing left for savings, emergencies, or basic life expenses. Instead, focus on what you can truly afford. A good home at the right time is better than the wrong home bought too soon. And the third trap, I'll save more later. This one is subtle. It sounds responsible, but it often leads to inaction. The truth is, small steps now are more powerful than big plans you keep putting off. Start with what you have. Save $10, $20, $100. Build the habit first. The amount can grow over time. Waiting for the perfect moment to start saving or the perfect time to act can leave you stuck. Forward momentum, even small, is better than standing still. Your mindset matters. And when you stay grounded in reality, not fear, not pressure, not perfection, you are far more likely to make decisions that support your future. In the final section, we will wrap up with a few key takeaways and words of encouragement as you move forward in your housing journey. Let's bring everything together. Saving while renting or buying is not easy, but it is possible, and it is absolutely worth it. It takes effort. It takes discipline. It takes patience. But every small step you take now is a building block for your future. Maybe you are renting and trying to stay ahead of rising prices. Maybe you are saving for your first home. Maybe you are just trying to survive this housing market without going broke. Wherever you are, know this: you are not behind. And you are not alone. The truth is, smart decisions today lead to financial peace tomorrow. That does not mean being perfect. It means being intentional. It means knowing your numbers, asking the right questions, and giving yourself grace as you figure it out. If this video helped you feel more informed, more focused, or more confident, do me a favor. Hit subscribe and share it with someone else who's navigating housing costs too, because when we learn together, we grow stronger together. Thanks for watching, and I'll see you in the next one.